and welcome to today's webinar, Everything Your Advisors and Lawyers Didn't Tell You About the Fundraising Process. I'm Cassie Pallison, Head of Content at Atrium, and your moderator for today's webinar. Before we get started on webinar logistics and introducing our speakers, I wanted to tell you a bit about Atrium. Atrium is a full-service corporate law firm that uses modern technology to deliver legal services that are fast, transparent, and price predictable. Founded by Justin Kahn and backed by Andreessen Horowitz, YC, General Catalyst, and more, we are trusted by over 300 of the top startups and hyper-growth companies in and outside of Silicon Valley. Now to the webinar logistics. This webinar will roughly be 45 minutes of content with a Q&A at the end. You can submit questions at any point during the webinar by clicking the chat icon at the bottom of your screen and then submitting your question in the right-hand side panel that will pop up. Today, I'm excited to introduce to you our two speakers, two of Atrium's best financing attorneys, Ryan Connor and Alie Fulton. Ryan is an early member of Atrium's legal team and has worked to develop a client-first mentality at Atrium. He works quickly and accurately to close deals as fast as possible while negotiating founder-friendly terms. He also assists startups in their pitch and narrative practice before and during their Silicon Valley investor roadshow. Prior to Atrium, Ryan practiced at Cooley and Morrison Forrester. Alie is a corporate attorney focused on representing emerging companies and venture capital investors. She's advised emerging companies investors on over 70 venture capital financings. Prior to joining Atrium, she practiced at WilmerHale, where she was focused on buy and sell side M&A and founder formation. Let's get started, Ryan. Take it away.
Great, thank you very much. So I wanted to kick things off with a quick anecdote. As mentioned, I used to work at a law firm called Cooley in Washington, D.C. One of the clients that I worked with was an investor, and they were about to invest in a high-growth startup. The day before the financing, before a wire of about $50 million was to go out to a company, the company sent an update of what's called the disclosure schedules. The disclosure schedules, if you've never done a venture financing before, talk about basically what's wrong with the company. It's basically a gut check so the investors can understand really what's under the hood of the car. So one of the questions on the disclosure schedule asked if any of the founders, officers, or directors of the company had ever committed a federal crime. Now, the company sent over a revision to these disclosure schedules at around midnight the morning before the wire was about to go out. And the disclosure schedule simply said that the chief executive officer and chief financial officer had been convicted of robbing a bank and committing wire fraud about 2 years earlier. Our client, the investors, had no idea that this had ever occurred. The deal died immediately and the wire was never sent. So my first piece of advice is don't rob a bank before you go into a venture financing. In all seriousness, however, we want to cram in as much knowledge that you probably haven't learned on the internet, a blog, or an existing investor and advisor into this session. If you have any questions, please hold them to the end and we're happy to answer them. Our first topic is going to be secondaries. A lot of folks are a little confused what secondaries are. So the first thing I want to discuss is really what is a secondary. A secondary at a high level is a way for you as a founder or employee at a company to receive liquidity on your shares before an exit event even happens. So a lot of these companies, as you know, can take 7, 8, 10 years to receive liquidity. It wasn't always like that for a startup. In the 2000s and earlier, a lot of the companies took about 4, 5, even 6 years to get to an IPO. As we know now, a lot of those timelines are much farther down the line. So the question is how do you get liquidity in a Series A or Series B transaction? And to really put some understanding around this, I recently completed a financing for one of our clients. the financing itself was about $50 million in total. However, 10 million out of that 50 million went directly to the founders. And that was a later stage Series B financing. But the thing that's really important to think about here is the founders really walked away with anywhere between $1 to $4 million, which is obviously a life-changing event. And that was before any liquidity event or transaction really even happened. So the ask is, how do I ask for that from an investor? A lot of founders are kind of scared to ask for that because it obviously sounds a bit greedy. However, the way you ask for it is you simply say that having some liquidity in the bank will help you and your family work towards a higher liquidity event for your investors. For example, if you have a son or daughter that's going into college, or you have a large mortgage to pay off, however, you just don't have the cash to do it, taking some money off the table right now to satisfy those financial goals you have will help you move towards a longer term vision of your company. Investors don't want you to take an acquisition offer because it's very low and you need the money. They want you to hold out for the $1 billion transaction. That's really what will make the investors' fund succeed. So when you go into your Series A or Series B, be thinking, how do you negotiate for that? And it's very simple. You want to just ask for it. If you have multiple term sheets, something we always recommend, even if you're in love with your first investor and want to take their term sheet, it's always best to go out and obtain as many term sheets as possible. What does that do? It puts you in a negotiation strategy where you can come from a position of power. You can go to those investors that have given you term sheets and say, hey, I need some liquidity. I need a secondary, whether it's 100K, 2 million, 4 million. It's something you can ask for. And most of the time, what I've seen, especially recently, is most investors are willing to give it to you. The next question to think about is how to structure that secondary. I don't want to get into the details here because they can get complex with tax, but at a high level, there's basically two ways to do the secondary. One is the company actually buys back your shares from money from the company's actual treasury. The second is that you find investors to buy those shares directly. And it can be tough to find an investor that's willing to buy your common or founder shares because most investors actually prefer preferred shares because of the liquidation preference. However, it has happened in the last few deals I've been on, and most investors are willing to pay up to the price of preferred shares just for your common shares if there's enough demand in your company. Again, if you want to have a good advisor, an attorney that can help you understand the structure regarding that transaction, but it's ultimately going to be up to you as a founder to find the right investor who will buy those shares from you. And how do you find those investors? A lot of times you will find them from your existing cap table. It might be one of your angel investors that wants a higher ownership in your company. Or it may be an investor who's not leading your Series A or Series B round, and you don't have enough room in your actual preferred stock transaction to let them in the round, but you can always ask them if they'd like to purchase some of your common shares. I will now pass it off to Alie.
Hi, everyone. So if you're thinking about raising and you don't know how you want to structure your financing, we're going to talk about a couple of different options: the bridge round, a safe, or a priced round, and how to decide which one is best for your company. So just a general overview, a bridge round is the same thing as a convertible note financing that is typically going to be converted into equity at your priced round. The convertible note will accrue interest over time. The SAFE is a Silicon Valley standard to raise money before a price round or in between price rounds. It has a valuation cap and will convert in the equity financing, but unlike a note, it doesn't accrue any interest. A price round is your traditional equity round. An investor will lead a round at a fixed valuation, and you will issue preferred stock to your investors. So how do you decide? So I've worked with companies in the past who in retrospect should have done a safe round instead of a priced round. So they received a term sheet at a much lower valuation than they expected. It was a low round size and non-market terms. They were strapped for cash. They immediately signed the term sheet, and they had spent the last 6 months trying to raise with no luck. The company only ended up raising about $1 million on a pre-money valuation, and it took a few months to fill the round. Because sometimes a lead investor will require you to have all investors lined up in order to close. So in retrospect, that company didn't raise a lot of money. It took a long time, and they ended up with non-favorable terms. If they had done a safe financing, they would have just needed one document. They could have agreed to terms with the lead investor, closed that safe, and then over the next few months brought in additional money. So let's talk about a hypo about what you'd rather do for a safe round or a priced round. So say you have a term sheet for a price round. Investor will only do it if it's a price round, but they're not great terms like the ones I just described. What do you do? So it'll depend on a number of factors. How much cash do you have? How long have you been raising? Would turning down a term sheet be risky? But you could also leverage that term sheet to move a safe financing along. And so you need to decide whether accepting a low valuation or a safe would be better or worse for your company. So talking more about timing. So timing to raise a safe is generally pretty quick. Like I said, it's one form that you'll use to get with one investor, and then you can bring on additional investors later on. A safe round generally takes longer just because there are more documents involved. Investors will do more legal diligence, and more attorneys are involved, and so it takes longer. The timing of when you should be raising, I've seen more recently that safes are used as more of a pre-seed round. So when your company is just getting off the ground, but you're not quite ready to raise a full round yet, a lot of companies are using safes. And then I've also seen companies raise safes in between rounds. So if you're not ready to raise your Series B yet, but you want to get some additional capital and more investors working with your company, and hopefully they could lead your Series B, it's a great tool to get more interest in the company. And so other things that you want to think about when deciding between a safe and a priced round is that if you raise a priced round, you're more likely than not going to be expanding your board of directors to include a preferred director. I've never seen a situation where an investor will ask for a board seat in a note financing or a safe. And more often than not, those investors will help introduce you to other investors who could lead your priced round. And so usually investors will negotiate for a board seat during a priced round, and you need to think about whether or not you want that individual on your board. Other things to think about are marketing your company to other people. So if you're doing a safe round or a note, it's usually going to be private. You're not going to be making public security filings that can be scraped by a bot and picked up by Crunchbase or TechCrunch. And so, but if you're doing a priced round, you'll make public security filings. You'll usually do a press release, and it's more market proof that you're building something here and that investors are interested. Other things to consider are the economic and operational controls you'll be giving up when you raise a price round. Economic controls are things that impact the economics of your daily business. So agreeing to a liquidation preference, agreeing to pro rata rights going forward, and giving up voting rights to things that you have to do on a going forward basis. Operational controls are things that impact how the company operates on a daily basis. So the board structure that I mentioned earlier, you'll now have a preferred director that you'll need to include on approvals for things. Other things like protective provisions that are in your charter are things that you'll need your preferred stockholders to approve before you can take any additional actions. So those are all things that you should consider when deciding to raise your first round. So I'll pass it back to Ryan now.
Thanks, Alie. The next topic we're going to cover is for folks that have already been through a Series A, is how the Series B is a little different. If you've not had a Series A yet, this is also really important because it is important to understand how your Series A, or perhaps your Series seed round, or even your first SAFE or note financing can really impact the trajectory of your company. I'll try and give a real life example here. There is a company that I had been working with on the East Coast that had experienced a lot of trouble finding financing for their initial seed round. Most domestic investors just were not biting on their narrative and their business model. However, they were able to locate an international investor, and the international investor gave them a term sheet that was pretty draconian. And the reason it was very harsh was it contained what's called founder reps and warranties. That's always a red flag, because that means if there's something wrong with the company's reps and warranties, let's say a document was misplaced during the incorporation, the investors themselves can go after you personally. They can go after your house. They can go after your wife's house if it's community property. There's a lot of things that can go very wrong when you have founders, reps, and warranties, and basically flies in the face of the corporate structure in that corporations are designed to really protect your personal assets. So I strongly advised against this term sheet for that reason, but the company went ahead and moved forward with it because they were in a crunch for funding. And the main principle that I hope you walk away from this exercise with is the principle of what's called permanence. Every clause or term or really anything you give on from a negotiation standpoint in an earlier financing will stick with you throughout the life of the company. So in our case, with the client I was working with, they went on to raise a Series A and B financing a few years later. When they received new investors in those Series A and Series B rounds, it was impossible to get the founders' reps and warranties out of the documents, even though it was not standard and not market really domestically to have them. Because the early investors had received them, all the later investors wanted them as well. So that's generally one of the biggest mistakes I see is with early stage companies agreeing to terms because they're in a funding crunch and not being able to get rid of them in later Series B rounds. So one thing that is kind of a hypothetical that I always float to companies is, what can you do to prevent choices you make in your Series C round or earlier Series A round from hurting you later down the line? And one thing that we advise a lot of our companies to do is, with earlier Series C or Series A term sheets, you can actually negotiate to have a lot of the provisions fall off at a later stage financing. For example, if you receive a term sheet from a really early stage Series seed fund and you don't want that director staying on with the company as they go into the Series A or Series B round, you can actually put into the term sheet that the Series C director will fall off the board should you go into a later round. However, I do want to cover what the Series B looks like as compared to the Series A. What I like to call it is the liquidation dance. It's really the most important concept to understand from a board level and from a company management perspective as the company moves on to later stage financings. And what that really gets at is the different competing interests at the board. At the Series A round, you really only have one director that is going to be interested or have a veto right on acquisitions. However, at the Series B or even later Series C round, you may have as many as 2 or 3 or 4 different investors that have completely different economic incentives, meaning that the earlier stage investors might be more interested in an earlier acquisition. Perhaps your company gets a term sheet for 100 million, 150, or even an acqui-hire of a 50 million. The early stage investors will be totally on board with a smaller acquisition like that because they'll have a high return on their early stage investment. However, the Series B or even Series A investors that just put a sizable amount of money into the company. For our case, it would be one of our lead investors at Atrium would not be as willing to sign on to an acquisition that did not provide sufficient return and liquidity on their large investment. For example, our investor that just put in $50 million into Atrium would not be on board with us selling the company for $100 million because it would not generate enough return for their fund. So it's something you really need to understand, that when new investors come on board, they're not always going to get along super well with the Series A investors or the earlier stage investors, simply because they have totally different economic incentives. So the next thing to really think about is, how do you protect yourself going into later rounds in regards to board structure and board control? At Atrium, what we've seen is about anywhere between 75 to 85% of our Series A deals result in boards where the founders still have control, meaning that the board cannot really terminate or fire them as founders. However, that number is much less going into the Series B, meaning that they lose board control and the founders have less control in these later rounds. So how do you protect against that? Again, it comes back to our real incentive to have multiple term sheets. If you have multiple term sheets, you can then negotiate for a board whereby you do not lose board control. One example is when Justin was at Twitch, he actually had 3 board seats really just for him as a founder. 2 of those seats remained vacant really up into later stages of the company, but that helped him whenever there was an important board decision to keep control and also protect his employment at the company. So again, the more you can create a competitive environment for your company going into the funding round, even at the Series B or Series C level, the better you'll be able to negotiate for a competitive term sheet where you can still retain control of the company. I will pass it back off to Alie.
Okay, so now we're going to talk about who your audience is when you're pitching to investors, strategics versus traditional venture capital companies. So the key difference between a strategic investor and a traditional venture capital investor is what their incentive is to making the investment. Traditional VCs are generally more focused on the financial return of their investment, like Ryan just touched on. They want to put in money so they can get a return for their fund. Strategic or corporate VCs are focused on both the financial return and the ongoing partnership between the company they're investing in and their parent company. So some examples of corporate VCs are the venture arms of different companies, different large corporations. For example, Google, Samsung, and then traditional VCs, we've mentioned a few today, General Catalyst, A16Z. So let's start by talking about how to pitch them and a story from one of my former clients. So I had a former client who was in the semiconductor space, and they were really interested in partnering with Samsung. They were out pitching traditional VCs because they did not think that Samsung would lead their round, but mistakenly used the same pitch deck for their traditional VC pitch and the Samsung pitch. And Samsung passed because you need a really different strategy when approaching corporate VCs. They failed to adapt their strategy to really cater towards Samsung. Samsung's interested in what the company can do to solve a Samsung problem, not just how they can get their money back. So you really need to have a completely different approach when you're talking to corporate VCs. Another example would be if you're a payment processing company and you want to pitch to Stripe. How would you pitch them? Well, the key would be to understanding Stripe's overall business and really playing into their incentives and how you can market yourself to be a good partner down the line, or a potential company for Stripe to acquire. So some other things that you want to think about when dealing with strategics is that they're going to have different incentives and additional parties to answer to when they're handling the investment. So a strategic investor who has a larger stake or sits on the board could potentially block an acquisition from a competitor. So it's great when you want Stripe to acquire you, but if you want a different company to acquire you who competes with Stripe, they may block that. So it's the same with giving them too much control in the company or a board seat. Additionally, corporate VCs will sometimes try to negotiate a right of first offer to any acquisition when they negotiate the financing documents. So what that means is that if you get an acquisition offer from a different company, you'll need to disclose that to Stripe, and then Stripe will have an opportunity to make you a better offer. Other times, because strategics are really focused on the company's revenue and other targets, they will require non-standard terms in your stock purchase agreement and additional covenants that will require the company to reach certain milestones and revenue targets in order to get additional funding from them. I work with a company where the investor required them to hit multiple targets before the additional closing date, which was 4 months out. They missed those targets, and then they missed out on the additional funding. We are able to amend the milestones to make it more favorable for the company down the line, but they really needed that additional funding after those 4 months. So how and when to approach strategic VCs? Generally, everything takes longer with them. They have a higher corporate structure to work with. For example, if you're pitching to Google, they have a huge parent company, Alphabet, and so it's going to take a lot longer. It can move faster if you already have a term sheet from an institutional investor and you're just pitching them to follow on the round. But because most corporate VCs will not lead around. Some do, like Stripe, but it's better just to push it out as far as you can to start those conversations early.
Great. Now we're going to go into Q&A. Before we dive into that, I just wanted to ask Ryan, you one question. A lot of people were listening today, maybe concerned with how they're going to get a term sheet in the first place. So do you have any suggestions on how companies can get investor meetings and term sheets in the first place?
Sure, that's a really good question. And again, I'm sure if you are thinking about all these legal issues, but without really having a funding source or a path to get there, it can be not the best use of your time at this point. But going exactly to your question, there's a lot of money out there right now, and regardless of the macroeconomic situation, there's a lot of funds that have raised money and need to deploy those funds. There's a kind of set of metrics that we generally like to see for Series A companies, and we're happy to meet with anyone to discuss kind of what those are and what you need to do to be competitive in the Valley. But what we have seen generally is it can take anywhere from like 6 to 8 months from the time at which a company decides they would like to raise to getting money in the bank. And a lot of founders sadly kind of misjudge the amount of time it will take to find the right investor. But you want to have a great project managed experience, meaning you're only talking to investors and only speaking with folks that have a high likelihood of interest in your company. We've seen a lot of companies recently that have really great numbers and would be competitive companies, but they haven't really spent the time to create a narrative and storyline that will attract investors. And we really specialize that on Atrium, is actually helping on the earlier stages of the fundraising process in helping companies really understand what investors are looking for. And I can't emphasize enough that even if you do have the numbers to raise, you've got to make sure you understand how you're pitching and why you're pitching your company, or you will run out of money if you don't project manage it correctly.
Great. Okay, we're going to mute really quick just to sort through the questions and just give us 30 seconds to come back online and answer all the questions coming in. So don't forget to submit them. There's a button on the bottom panel called chat. So going back to the market proof when raising, why is it important to get coverage in TechCrunch or not?
Yeah, that's a really great question. I think that it depends a little bit where your company life cycle is. If you're going out to raise your Series A, what we like to do here when we send out email introductions from Atrium to investors and prominent Silicon Valley VCs, it can help to have a little bit of press coverage and have an article that links to what your company is doing. Press coverage by itself will not help you fundraise, but it will provide a little bit of clarity for when you're introducing yourselves and going on to a roadshow, whether it's a Series A or Series B company. The other way to answer that is like, why go and TechCrunch after you've raised a round? I think it's the same thing as well. When you go out to raise a Series B and you want to quickly and easily explain what your company does, it's very easy to link to an article as long as that article is well done. Sometimes a TechCrunch article really won't describe what your company does, and you want to make sure that it's the right article. Otherwise, you really don't want to use it when you're explaining your company to investors.
Another point to add is if you're trying to hire aggressively after you raise, and any press release is going to garner a lot of interest from potential employees.
Great. And what stage should one approach corporate venture capital?
Sure, so that's a pretty good question. There's kind of two schools of thought here. Generally, when folks go out to do their Silicon Valley roadshow, we actually send them to corporate venture capitalists first, just because corporate venture capitalists have a much slower and longer decision process. So you actually want to start talking to those people first, assuming that they're corporate venture capitalists that will not lead the round. And most corporate venture capitalists will not. However, there's some that do lead the round. For example, Google Ventures will lead rounds. If it's someone that will lead the round, you want to meet with them pretty much at the same time, at the same point in your fundraising process as you're meeting with all the institutional investors. Generally, it also can help. The second school of thought is that you only speak to them after you have a term sheet from a lead institutional investor. And that way, it'll put some pressure on them to actually move faster and have make a decision. So you would approach them really right after you sign and execute a term sheet with a lead investor. That way, there puts some pressure on them and say, hey, our round's being full. We can allocate 500, a million, 1.5 for you. Are you in or not? So there's really kind of two schools of thought there, and you can really kind of go one or the other. If you're certain that you want to have a corporate VC in the round and it would really help your business model and what you're trying to do, I would generally go with the first approach of talking with them earlier. However, if you are not as certain to the value they can provide, I think it's easier to put some pressure on them. And if you really want to close around very quickly, I would approach them after you sign and execute the term sheet with the lead institutional investor.
Awesome. There's a lot of questions coming in. So is it typical to give a board seat in a seed round?
So that will generally depend on the size of the seed round. More often than not, I don't see seed investors taking a board seat. They'll usually take an observer seat. And what that means is that they're invited to, a representative from the fund is invited to a board meeting in an observer capacity, and they're not able to vote on board matters. I find that I've been to a lot of board meetings and they provide a lot of great insight. If an investor is putting in $1 million and you're already thinking about your Series A, I would maybe not agree to allow them to be on the board, or you could put a provision in the agreement where they'll step down and be replaced by a Series A director when you do raise a Series A.
Great. What do I do if a VC fund wants me to reset my vestings?
Yeah, so what that generally means is that in an early stage financing, an investor is investing in the company and in the founding team. And so you'll generally have vesting on your shares, and that is a way to keep you incentivized and working on the company. If it's been a long time since your shares are fully vested, or you have non-standard vesting terms, a lot of times investors will ask you to reset your vesting, meaning starting either all of your shares over or a portion of your shares to start vesting again, or to get you on standard vesting terms. Usually this should be discussed at the term sheet stage, or if an investor finds it during legal diligence when reviewing your equity agreements, they may ask for it later.
Yeah, not a whole lot to add there. I think the one thing is you want to be really careful. If it's not specified in the term sheet, you want to make sure that it is specified. I would never sign a term sheet unless it's really clear what the vesting provisions would be. The other thing to think about is what's called single or double trigger acceleration, which I won't go into, but you can Google very easily. But it's also something that could be amended or changed during the course of the financing, and you want to make sure is spelled out in the term sheet itself.
Great. It sounds like someone here is a sole founder and is looking for equity to potentially give a co-founder. And so how should he go about that when seeking a seed fundraising and considering equity between co-founders?
Sure. So it sounds like there might be two questions here. One is, when a co-founder comes on, what amount of equity do you give them? There really is not a standard market answer for that. A lot of people ask that. And a lot of people say, 51 versus 49%, which I don't think really provides any value. I think on paper it might look like it, but after the company raises a funding round, that breakdown or percentage really isn't going to mean a whole lot in terms of the voting. It's really the amount of value you think this person is going to provide. And I think you always want to realize that you want to justify whatever equity you give them to your Series Seed investors. If someone's going to have 30 or 40% of the company at an early stage, the investors are going to know, is that person really worth the equity that you're giving them? So regardless of what you actually negotiate between the two of them, you want to be able to really make sure you can justify that equity breakdown to the Series Seed founders. As to the second point of kind of going into a Series Seed financing and what to expect, there really isn't a whole lot to add there, other than you really want to make sure that when you bring on that founder, that you guys both either have the same vesting schedules or you don't have any vesting at all, that you then put in place at the preferred stock financing.
Great. And last question. I see some questions coming in around pre-money and post-money safes. Can you kind of explain the difference between those and what to consider?
Yeah, so the post-money safe is a new form of safe that YC recently put out. And the old form is now what we call the pre-money safe. And so the new form provides a clear picture to investors of their ownership after the safe converts. And so it's being converted on a post-money basis. And it's really, it's beneficial to the investors, and it's beneficial to the company if you know how much you're planning to raise in your safe round. If you know that you're going to be raising $10 million and then in 6 months you're going to raise a price round and you're not going to raise any additional safes, it's great for both parties. You know exactly how safe ownership is going to come out during the price round, and so does the investor. If you raise more, then it's going to dilute the founders and not the safe holders. Previously, when you raise additional safes, it would just keep diluting the existing safe holders. But now when it's being calculated on a post-money basis, the only one that's going to take a hit are the existing holders. Another pro to the post-money safes is that it takes out the pro rata rights section. So if you have raised previous safes, you're probably giving all those safe investors pro rata rights in your next equity financing. The new safe just takes that out and makes it an optional side letter. So I don't think that many investors will be asking for this going forward.
Great. Well, that's it for today. I know there's some questions we did not get to, but we will follow up with you. And thank you so much for your great questions and engagement. This webinar was recorded and will be emailed out to you within a few days. And we do have our next webinar coming up on March 19th. So we will email that out as well with the recording of today's webinar. Thank you very much, and hopefully this was insightful.